Hey guys, the Reset Sniper here. Been a bit since I've spoken to you, and I'm happy to be back. What I want to talk to you about is a particular topic that I'm kind of real passionate about, and it's one that many people have missed in terms of how the great game is going to go down. And it was the events of long-term capital markets, LTCM. Now, it all went down for LTCM, in other words, the collapse, in 1998. That's right, 1998. And many of you may not have been active trading, or you might have been only partially financially interested, and it just sounded like some hedge fund story, blah, 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 blah. Yeah, there's companies going bust and etc., etc. And you didn't pick up on the great relevance of long-term capital management. And I want to tell you how LTCM, the seeds of 98 collapse, were actually the seeds and the pattern of behavior for the 2008 collapse, which itself 2008, because you're probably saying that's all history, which in of itself, the same pattern and the same kinds of individuals have already more than laid the seeds, fertilized, and the bitter harvest is well on the way for the forthcoming major reset collapse. Bang. And to understand your past and your history is to better understand what may be coming for you in the future, and also to recognize the signs and how also you can prepare for that. So it's not just misery porn. This is an attempt to understand where we are in the timeline, who the key actors are, who should be listened to, who should be taken at an honest level, and who should be absolutely masonically inverted to do exactly that which will propagate the further collapse, not protect from the collapse. So a little bit of an intro there for you. LTCM collapsed in 1998, and the shining stars that were all around, that were assigned to become, in fact, Times magazine said in 98, in fact it was 99, just months after the final catastrophe, because it rolled across a year. It was all going pear-shaped in 98 and rolled into 99 in much the same way that 2009 was actually the bottom of the stock market in March. So the damage of the year before continued to roll for a number of years. In 99, Time magazine featured your heroes, Greenspan, Robert Rubin, Larry Summers, on its cover. These three guys, and under the headline, remember, your controlled mainstream media suckers take you for absolute morons. The committee to save the world. Drama queens indeed, in both their headline writing and utter deception, because they were no friends at all of the people in terms of how they went about it. In fact, far from learning the lessons of 98, those guys actually set about making sure that 2008 happened. That's right. And what I'm interested in potentially doing for you is serializing this. But I want a favor from you. I need 500 likes on this YouTube, and then I will commit to free view serial on the long-term capital market debacle. And I'm going to give you just a taster now. Those three individuals, including later Timothy Geithner, understudy and protege of Robert Rubin, the Bill Clinton presidency rolling into the George Bush presidency, where certain both Republicans and Democrats forged their way and pushed through bills that did the following. And hear me now when I explain some of what went down. So following the collapse of long-term capital, what actually happened is the Glass-Steagall Act, an act of over 6 decades that came in with the Great Depression, that separated deposit-taking banks from security issuing investment banks, so that never would depositors' monies be risked again, was repealed. So we had a major over-leveraged hedge fund fail that got a government backout. This was private rich man's investment capital fund chasing supernormal returns using untold leverage, doing it in swap deals, not through an exchange, where there was no initial margin even posted. Only mark-to-market margin at a very, very low rate. Not through any exchange, but through private contract. Swap deals is me contracting with you. No one else even knows the degree of risk that they were taking and the scale of their leverage. And in that event, that long-term capital collapsed with over-leverage and the need for greater oversight and for derivatives to be pushed through an exchange where people could know what risk was out there that had been traded through an exchange and could see real initial margin posted for holding open opponents, and the degree of leverage is controlled. Instead of taking and pushing all those swaps back onto the market, the result of the failure of long-term capital, thank you to Greenspan, Rubin, Summers, and later Geithner, and Bill Clinton in his final act as a president, not only did he repeal the Glass-Steagall Act, which later allowed Citigroup to merge with Travelers, which subsequently saw the same Mr. Rubin, the same Mr. Robert Rubin, who was the Khazarian Ashkenazi whisperer in Bill Clinton's ear as Treasury Secretary, the same man become board director on Citigroup post the merger, earning hundreds of millions. That's right, you heard it right. And what ended up happening as a result of long-term capital with all the individuals I've named is they not only ignored and sidelined two separate ladies, in fact, that were wanting the swaps to be moved on to exchange. They marginalized them, had them set aside. Rijkaard himself tries to post this as a misogyny event because essentially all of these saviors were male, and the two protagonists for proper financial conduct were in fact female. I say he's inaccurate. These were Zionists, all to the core, planning, plotting, Kabbalist insiders with a key agenda that they knew. Because why? How do you go through the collapse of long-term capital markets and actually repeal after that the Glass-Steagall Act? How do you then allow bills to be passed that then allows these newly formed security companies that are all attached to depositing banks, as everybody rushes to add risk and have the benefit of your money, your check account money as a deposit taker in their account, then allow for far greater leverage? Basel I was watered down to include and allow far higher levels of leverage, all being pushed through various Republican and Democrat senators who were all on the bankers' payroll, giving more leverage post long-term capital markets. No need to register swaps through exchanges. Private contracts could continue to be done on the sly. No reporting standards. Bank capital requirements were reduced. So you have a major financial collapse that required governmental and state-based intervention to shore up a hedge fund. And as a result, the medicine is kill Glass-Steagall, decrease the capital requirements for banks. They were eased. Derivatives regulations that were put forward were removed. And in 2003 and 2004, broker-dealer capital requirements were also eased. Further to that, throughout that entire period, the Fed itself, aka Greenspan, later to become Bernanke, kept interest rates artificially low. In other words, it's a very low yield environment. Everyone chasing yield, provide leverage with low yield, and you can make money again. It was as if the global reaction to long-term capital was in fact designed to bring about the 2008 collapse. And I'm going to add a further point to that. They actually allowed banks to pledge all varieties of assets to attain even higher levels of leverage. And they gave a specific asset category, a brand new one, a shiny new one that people knew so little about. They gave that particular asset category an even higher allowance for leverage if you held it. What was that category? Newly created collateralized debt obligations based on mortgages, aka housing market. So if you were a financial institution, you could borrow far more and leverage up far more and chase up a higher return by taking untold amounts of debt to an ever higher level if you owned and bought and created, and obviously creating huge demand for these new policy instruments, which were effectively mortgage debt. And you then wonder why all the mortgage brokers had people banging on their doors and saying, as soon as you issue mortgages, just securitize it to us. We will take all you've got. These financial institutions suddenly became extremely hungry for the specific asset class, driving mortgage brokers to ever higher heights, telling them to push ever greater incentives, push ever lower discount rates. They are paying premiums for this asset category. Now, you might think, all those events, cancellation and repeal of Glass-Steagall's Act, following a financial, derivative-based, excessively leverage-based crisis, is coincidence. Repeal Glass-Steagall, in other words, remove the protection of depositors from casino banking. Number two, Basel I, reduce and water down the capital requirements for banks. Number three, press interest rates super low, where you have both Fed chairmen in the room, first Greenspan, later Bernanke. Four, give them the special asset category that if you own 1 unit of CDO on mortgage back, you can borrow 100x, while if you just own treasuries, you can only borrow 5x, for example. Those are not specific numbers, by the way, creating thereby an immediate demand across all financial institutions for that asset category. Tell me now that those responses made any sense in terms of coming directly out of the collapse of the 1980 and 98, 99 long-term capital crisis. Tell me now that they are an accident. Tell me now that they were remedial for what actually happened. And I will say, you don't understand the nature of that crash. Not only did they drop every rule, they took it to the extreme in the opposite direction to what was required consistently, marginalizing any voices that said, hang on, we should be doing this, aka going that way. We should be going north. And they kept turning around, belittling and taking you south, deeper into the dark valley and the forest where the predators live. That is the story of how we reacted to long-term capital markets. You can decide whether these were all individual actors just with bad judgment, or whether in fact this was an entirely engineered with intent. You always get the society you incentivize. You want to create demand for a new product that's suddenly being created by ex-Salomon brothers, John Merriweather, now sitting in long-term capital markets, who's created a mortgage bond product. You want to create demand for it. You say, hey, you own that, you can borrow a whole bunch more. Well, I know what I think. It matters what you think. I'm ready to serialize the whole story of LTCM for you in YouTube, but I don't want to be talking to a room full of 4 people. It's going to take effort. It's going to take a bit of commitment. I'd love to tell you the whole story. And more importantly, I want to tell you about what they've done for the 2008 version of long-term capital and what it means for your next collapse and who the actors are. So if you're really interested, share and like this, and I'll be back to serialize it. 500 likes and I get to work. Till then, keep playing safe. By the way, important, play defense, save yourself. This music is getting high. The Fed right now, oh, we've got to put interest rates up. We're going to be raising interest rates. This is the people that have got more debt than they even know to, that couldn't pay an honest, real, proper interest rate, which was the traditional 5 to 6% in a normal economic environment on the assets, if they even got quarter way close to it, are now telling you they're going to ramp interest rates. Where does this end? Where does it lie? You need to trade defense. We've been very deep into this recovery. We have a webinar for you if you're interested in trading in your wealth. It's going to be July 3rd. Register on themarketsniper.com for that, as well as sharing for your likes. And we will tell you how we will be positioning, and how with a method and the right markets, particularly in crypto, but in other markets too, you can protect yourself, build your wealth in spite of a negative environment, a major crash or collapse, and even in this interim market until we get to that point. Themarketsniper.com. Go check if it suits you. It doesn't suit everybody. And in the meantime, share, and I hope to be telling you more about the long-term capital market collapse, all the key actors and how they responded, and how since then, in 2008, they're responding towards the road to ruin, and this one will be even bigger than before. LTCM was your drill for 2008. Let me say that again. Long-term capital management was the minor drill for 2008. They got society and government, backed by you, the taxpayer, to bail out a private hedge fund. They kept the rewards, they socialized the loss. Now, I'm going to tell you how 2008 is just a drill for what's really coming. And it could be exciting if you position well. It could be very painful for those that don't. Look forward to speaking to you then, and that is the end. Speak to you soon. Love you, love you, love you. 500 likes. Thank you. Share is care.